Hello class, today we're going to talk about Chapter 24, Capital Budgeting and Investment Analysis. Capital budgeting is the process of analyzing alternative long-term investments and deciding which assets to acquire or sell. Common examples of capital budgeting decisions include like buying a machine or building versus acquiring an entire company. The objective for these decisions is to earn a satisfactory return on your investment. The process begins with the managers submitting proposals for new investments in a plant asset. A capital budget committee will then evaluate the proposals and they make recommendations for either approval or rejection. Finally, the board of directors will approve the capital investments for the whole year. Now, capital budgeting decisions require a lot of careful analysis because they're usually the most difficult and pretty risky decisions that managers make. Specifically, a capital budgeting decision is risky because the outcome is uncertain, large amounts of money are usually involved, the investment involves a long-term commitment, and the decision could be difficult or impossible to reverse, no matter what the outcome is. The risk is especially high for investments in technology due to innovations and uncertainty. Managers can use several methods to evaluate capital budgeting decisions. Most methods use expected future cash outflows and inflows. This exhibit 24.2 summarizes cash outflows and cash inflows over the life of a typical capital investment. An investment begins with an initial cash outflow to buy the asset, and then over the asset's life, it will generate cash inflow and cash outflow. Cash inflows are from related sales. Cash outflows are for things like materials, labor, and overhead to maintain the asset. This does not include depreciation. At the end of their useful lives, some assets can be sold for salvage value, so that would be another cash inflow coming in when you sell it. Now, salvage value is an asset's estimated value at the end of its useful life. There are different methods to help us choose among investments. Many use the net cash flow method, which is cash inflows minus cash outflows. So let's first look at computing the payback period and describing its use. The payback period, or PBP method, is a method used to evaluate investment decisions by measuring the expected amount of time to recover that initial investment that you make in the asset. So managers will prefer assets with shorter payback periods because if you think about it, that reduces the risk of an unprofitable investment over a longer time period. The formula to compute the payback period of an investment that produces equal or even or the same net cash flows over a period is the initial investment divided by annual net cash flow. So basically what you're calculating here is how many periods will it take, how many months, for example, will it take for me to earn back that initial investment that we paid for the asset. So let's look at how the payback period method works when you have equal cash flows. Remember, that means that each period that we're looking at has the equal amount each period of net cash inflows. So we have Fast Track, which is a manufacturer of exercise equipment and supplies, and they are considering investing in a machine to manufacture a new product. So management has gathered all the data shown up here. We have an initial investment of $16,000. That's how much it costs to buy the machine. We have a useful life of 8 years. The salvage value is 0. They expect to sell 1,000 units in 1 year, and the selling price per unit is $30. Exhibit 24.3 shows the expected annual income and net cash flow from an investment in this machine during its whole useful life, so for the whole 8 years. So we see its annual income is $2,000, but its net cash flow is $4,000. The difference is because the $2,000 of depreciation expense has no cash outflow. Remember, depreciation expense is not a cash item. The formula to compute the payback period of an investment that produces equal net cash flows per period is shown here in Exhibit 24.4. So we have the initial investment, the $16,000, divided by the annual net cash flow, which is $4,000. So that's 4 years. Again, remember, the payback period assumes that the cash flows occur evenly within the year, within each time period. So that's years in this case. And just to reiterate, you need to pay attention to the difference between cash flow and income. Like if you pull these numbers straight from the income statement, that will help you understand what the income is for the period related to that asset, but it's not the cash flow, because you got to remember depreciation is not something that cash is paid out for. So that's why you need to go through the calculation to figure out what the actual net cash flow is. So we have the cash inflow, which is the sales, minus these other expenses, which are your cash outflows. And that's how we got to the $4,000 to divide it by. So what do we do if the net cash flows are unequal or not the same each period? Well, then the payback period is computed using the cumulative net cash flows. Cumulative just refers to the fact that we add each period's net cash flow as we progress through time. So to demonstrate, Fast Track is evaluating an investment in a machine that will generate unequal net cash flows over the next 8 years. The data and the payback period computation are shown here in Exhibit 24.5. So at the beginning of the year, we have the $16,000 cash outflow to buy the machine. But by the end of year 1, the cumulative net cash flow is $14,000, computed as the $16,000 initial cash outflow plus 1 year of cash inflow, which is $2,000 in this case. So that's how you get to the end of year 1 of $14,000 net outflow. The cumulative net cash flow changes from negative to positive in year 5. We see at the end of year 4, the cumulative net cash flow is $2,000. So when Fast Track receives $2,000 of the $4,000 year 5, that's when it has fully recovered the original $16,000 of initial investment. Now, if we assume that cash flows are received evenly within each year, receipt of the $2,000 occurs halfway through the 5th year. This is computed as $2,000 divided by year 5's total net cash flow of $4,000, or 0.5 or 1/2. This yields a payback period of 4.5 years, computed as 4 years plus the 0.5 of year 5. So that gives you 4.5. So companies like short payback periods to increase return and reduce risk. The more quickly a company receives cash, the sooner it's available for other uses, and the less time it's at risk of loss. The payback period has 2 strengths. 1, it uses cash flows. 2, it's easy to compute. The payback period has 2 weaknesses. It ignores cash flows after the payback period, and it ignores the time value of money. Its weaknesses are pretty big ones. To illustrate cash timing, if Fast Track had another $16,000 investment with predicted net cash flows of $6,000, $5,000, $2,000, $1,000, and $4,000 over its 5-year life, its payback period would also be 4.5 years. However, this alternative is preferred because it returns cash more quickly. To illustrate longer-term cash flows, an investment with a 3-year payback period that stops producing cash after 4 years might not be as good as an alternative with a 5-year payback period that generates increasing net cash flows for 15 years. So you can see why there are some drawbacks of the payback period method that are, pretty significant. Now let's look at how to compute the accounting rate of return and what it's used for. Okay, so the accounting rate of return, also called the ARR, is an investment's annual income divided by the average amount invested in it. To illustrate, we return to Fast Track's $16,000 machine example, as we described previously. So we first find the average amount of the investment, and that's just the initial investment plus the salvage value divided by 2. So that gives us an $8,000 average investment over the asset's life. Then, to calculate the accounting rate of return, we just take the annual income that was determined back in Exhibit 24.3. And remember, the annual income is different than the cash flow. The annual income was the sales minus all the related expenses. So this time it did include depreciation expense because it's the income statement, not the cash flow. So we take the annual income of $2,000 and we divide that by the average that we just calculated. And that gives us a 25% accounting rate of return. Fast Track Management uses the 25% to compare it with alternative investments. Managers prefer investments with a higher accounting rate of return. Management also sometimes sets a minimum required rate of return. So using the accounting rate of return to evaluate investments has 2 major weaknesses. It ignores the time value of money, and it does not directly consider cash flows and their timing. Remember, as I mentioned, we were using the income, not the cash flow, when we were calculating the accounting rate of return. So this one ignores the cash flow. So now we're going to talk about how do we incorporate the time value of money, since that was one of the major weaknesses of the previous 2 methods. Net present value analysis applies the time value of money to future cash inflows and cash outflows of a project to assess its desirability. Now, you probably remember learning this from the previous appendix that we went over, Appendix B. It explains the present value concept, which is often summarized as a dollar tomorrow is worth less than a dollar today. Assignments that use present value are solved using the tables that you'll find in Appendix B or Excel or a calculator. Net present value is the discounted future net cash flows from the investment at the required rate of return, then minus the initial investment. A company's required rate of return, often called its hurdle rate or its cost of capital, is an average of the rate the company must pay to its lenders and investors. So now let's look at the net present value when you have equal cash flows. A company is considering a $20,000 investment in a machine that is expected to provide a $10,000 annual net cash flow. The company requires 9% annual return. The net present value is computed down here in Exhibit 24.8. So this exhibit shows the annual net cash flows. So that's this column right here. So we see $10,000 at the end of each year. And then it has a column for the present value of 1 at 9%. Now, these discount factors were taken from Table B1 in Appendix B. So to simplify present value computations for all of our assignments for purposes of this course, we're going to always assume that the net cash flows occur at year end. The annual net cash flows are then multiplied by the discount factors, so that's what we get in column 3 over here. And then you add up all 3 years of the present value of these future cash flows. And that gets you the $25,313. Now, to make a decision on whether we should invest in this, we compare that to the initial investment. So we take the $25,313, which is the total present value of net cash flows, and then we subtract out our initial investment, and that's the $20,000. And we come up with $5,313, which is a positive number. The decision rule is when the net present value is greater than 0, then that means you do want to invest in this asset. Hint, hint, there will be problems very similar to this on your exam for this chapter. So let's look at the decision rule in more detail. The decision rule in applying net present value is as follows. When an asset's expected net cash flows yield a positive net present value, then you should invest in the project. This decision rule is reflected in the graphic on this slide. If the net present value is 0 or positive, the project is acceptable since the promised return is equal to or greater than the required rate of return. When we have a negative net present value, that means the project is not acceptable. When comparing several investment projects of similar cost and risk, you should invest in the one with the highest net present value. So calculating the net present value is simplified when we have annual net cash flows that are equal. A series of cash flows of equal amount is called an annuity, as you probably remember from Appendix B. Table B3 gives us the present value of an annuity of 1 to be received over different periods. So to determine the present value of these three amounts discounted at 9%, you go down the 9% column of Table B3 to the factor on the third line for the 3 years. This discount factor, also known as an annuity factor, is 2.5313. So we then compute the same 25,313 that we did on the last slide by taking the $10,000, which is that annual equal cash flow, multiplied times the annuity factor of 2.5313. So you can see the calculations on this slide here. So the net present value analysis can also be used to decide whether to automate a production process. For example, an eyewear manufacturer is considering an investment in an $80,000 automated manufacturing system. If the investment is made, the company can reduce its labor costs by $15,000 in each year of the 10-year useful life of the system. So all other costs and revenues are expected to be unchanged, and we're going to use a 10% discount rate and a $0 salvage value. So considering this fact pattern, we can calculate the net present value. We see that the annuity factor is 6.1446, and we multiply that times the $15,000 in saved costs. That gets us the $92,169, which is the total present value of the future cash flows. And we subtract out our initial investment of $80,000, and again, we get a positive number down here, $12,169. So that means that the company should go ahead and continue to automate its process. The NPV analysis can also be used when net cash flows are unequal. Assume that the company can choose only one capital investment between projects A and B. Each project requires a $12,000 initial investment. Future net cash flows for each project are shown here in Exhibit 24.10. The two projects have the same total net cash flows of $15,000. Project A is expected to produce equal amounts of $5,000 each year, but Project B is expected to produce a larger amount in the first year and a smaller amount in the third year. So this exhibit shows the present value of one factors from Table B1, again assuming a 10% required return. Computation in the two rightmost columns show that Project A has a $435 positive NPV. Project B has a higher NPV of $908 because it brings in cash more quickly. Projects with the higher cash flows in earlier years are generally going to yield higher net present values. If only one project can be accepted, then Project B is going to be the better choice because of the higher net present value. So far, we've just looked at examples where your salvage value is 0, but many times the assets are expected to have an actual salvage value greater than 0. If so, this amount is an additional net cash inflow expected to be received at the end of the asset's life. To illustrate, an asset requires an initial investment of $80,000 and generates $15,000 of net cash flows for each of the next 10 years. But this time, it has a salvage value of $10,000 at the end of its 10-year life. Using the net present value computation, using again a 10% discount rate, the calculation is shown here. So as you can see, you have to calculate the $10,000, the salvage value. You have to calculate its present value as if it was a final cash inflow at the end of year 10. So that's where you find this factor. and you just add that into your total net present values and compare to your initial investment like always to get your net present value. Now obviously the net present value is higher because you have that additional cash flow. Like when comparing it to the previous exercise that we just did, it's going to be higher because you have that additional final cash flow coming in. When comparing projects of similar initial investment amounts and risk levels, we can rank them based on net present value. However, if the initial investments differ across projects, then we need a different method. One way to compare projects, especially when a company cannot fund all positive net present value projects, is to use the profitability index. This is computed as the present value of net cash flows divided by the initial investment. So that way it translates it into a rate that you can then use to compare against other projects when they don't have the exact same initial investment. So if you look at Exhibit 24.11, it illustrates the computation of the profitability index for 3 potential investments. A profitability index less than 1 indicates an investment with a negative net present value. This means that we can drop investment 3 from consideration. Both investments 1 and 2 have profitability indexes greater than 1. That means that they have a positive net present value. If we were forced to choose between the two, we select the project with the higher profitability index. Thus, investment 2 is ranked ahead of investment 1 here. Investment 2 returns 1.5 net present value per dollar invested, whereas investment 1 only returns 1.2. So the rule here is invest in the project with the highest profitability index, and it must exceed 1. Okay, finally, we're going to look at computing the internal rate of return and talk about when to use it. So this is another way to evaluate capital investments. It's called the internal rate of return, or the IRR. This equals the discount rate that yields an NPV of 0 for an investment. Stated another way, if we compute the total present value of a project's net cash flows using the IRR as the discount rate and then take out the initial investment, then we would get a 0 net present value. So now let's look at the IRR when you have equal cash flows. Assume that an asset requires a $12,009 initial investment, and it's expected to generate $5,000 net cash flows each year of its 3-year life. This slide shows us the 2-step process for finding the IRR when we have equal cash flows. Step 1, compute the present value factor for the investment project. This is the initial investment divided by the annual net cash flows. So in our case, we have $12,009 divided by $5,000, or 2.4018. So now that we have our present value factor, step 2 is to identify the discount rate yielding that present value factor. So if we search in table B3, which is partially shown on the slide, for a present value factor of 2.4018 in the 3-year row, then the 12% column is the one that shows a present value factor of 2.4018. That means that the IRR is 12%. So you're kind of using the tables backwards. Now for unequal cash flows, it's best to use either a calculator or a spreadsheet software like Microsoft Excel. And the book actually shows how to use Microsoft Excel in this chapter's appendix. To use the IRR to evaluate a project, we compare it to a predetermined hurdle rate, which is a minimum acceptable rate of return. The decision rule using the IRR is shown on this slide. If the IRR is greater than the hurdle rate, then you should invest in the project. If the IRR is less than the hurdle rate, then do not invest. So now let's compare all of these methods that we've been talking about. The payback period is the simplest method. Managers sometimes use it when they have limited cash to invest and a number of projects to choose from. So the payback period is the simplest. The accounting rate of return is simple but not commonly used in practice. The net present value considers all net cash flows from a project. It can be applied to equal and unequal cash flows, and it can reflect changes in the level of risk over a project's life. Because the net present value is in dollars, comparing projects with different initial investment amounts is difficult. The profitability index comes in, and you can use that when your initial investment is different. The internal rate of return considers all cash flows from a project. Because the IRR is a percentage, it can be used to compare projects with different investment amounts easily. However, the IRR does not reflect changes in risk over a project's life. So you can see why companies may use a combination of multiple methods whenever they're actually doing this in real life. And I can say, just as being an auditor for many years and seeing many different companies' records, the net present value and the IRR are definitely the most common. And let's briefly touch on break-even time as well. So break-even time is a measure of the expected time until the present value of the net cash flows from an investment equals that initial investment. So it's kind of combining the payback period, but using discounted cash flows. So it overcomes that weakness that we identified of the payback period where it ignored the time value of money. But in this case, we get to include the time value of money. So in this example, we have a $12,000 investment in machinery, and the expected net cash flows from this each year for 5 years is $4,100. So this shows a computation of the break-even time for this investment when we have a 10% discount rate. So as you can see in this column to the right, that the break-even time happens between year 3 and year 4. And technically the exact answer is 3.64 years. Now, how did they come up with that extra 0.64? You take this 1,805 and you divide it by the 2,800 present value of net cash flows for year 4. So basically every cash flow that's earned after that point contributes to a positive net present value. So eventually that comes down to equal 3,541, but your break-even time is the 3.64 years in between year 3 and 4. So break-even time is useful because it identifies the point in time which cash flows begin to yield positive returns. This method allows managers to compare and rank alternate investments, and giving the project with the shortest break-even time the highest rank.